Financial Ratios, Chapter 4, Part 1. After having seen how to create balance sheet and income statement of an organization, and how to analyze and interpret common size balance sheet and common size into income statement, the role of making ratios and comparing the financials with each other becomes very critical, typically because no two firms are equal or even comparable on the same scale. So we've seen how to analyze these common size balance sheet and income statement for unequal firms. After going through this presentation, we'll probably be able to take this analysis to the next level by comparing ratios of several different categories. So we'll be able to compute and interpret in particular three major categories of financial ratios. The liquidity ratio, which determines how the firm's ability to pay its short-term debt obligations. Solvency ratio, which refers to the ratio of debt, particularly the ability to raise debt, borrow money. And asset management ratios, how are short and long-term assets utilized to make sales and give either purchase credit or keep inventory levels at a certain level or make credit sales. And then later on, we'll talk about the remaining three types of ratios, which are profitability ratios, which basically determines how much profit the firm is earning with respect to its different categories, such as assets, sales, and equity. Then market value ratios, which essentially deals with stock markets. So how much is a shareholder paying with respect to the earnings per share, that is profit per share, or with respect to earnings growth, or with respect to the book value of asset per share if the firm were liquidated right away. And then finally, DuPont ratios, which compare in an interdisciplinary way. It compares the profitability ratio, the asset turnover ratio, and the solvency ratio to come up with the profitability of a firm, the return on equity to shareholders. So DuPont ratios are very powerful because they combine three different categories through mathematical manipulation, but which provide some really useful and important implications for an investor. So we'll first talk about the different types of financial ratios. Like we said, financial ratios are essentially the ratio or the comparison of two different financial numbers of an organization obtained through financial statements. And as we saw, there are five major categories of these ratios: liquidity ratios, solvency ratios, which deal with debts and with respect to assets. And then we talk about asset management ratio, which deal with how efficiently assets are utilized to make sales or receivables in terms of credit sales. Profitability ratios, which talk about the profits or net income or the net profit or earnings after taxes with respect to different benchmarks. And then market value ratios, which essentially talk about, like we said, stock market performance of the company's stock. So we'll move into liquidity ratios next. Liquidity ratios are typically short-term in nature, and there are three major categories. The current ratio, which is the ratio of essentially two components of net working capital. Now we know that net working capital is the difference of current assets and current liabilities. And typically it's expected that current assets are greater than current liabilities so that the firm is able to meet its current obligations with the help of its current receivables, whatever they are. So that's called current assets. So it's expected that the current ratio is more than 1. Then there's a quick ratio, which is current assets minus inventories divided by current liabilities. So it's taking the numerator down by the level of inventories. And the reason for this is really, for example, if Boeing is manufacturing or assembling fuselage with wings, with landing gear, takeoff gear, etc., and then all these parts are brought together at the assembling facility, but on their own, they may or may not have the same value as the value of the final aircraft. So the value of inventories, if a firm is liquidated immediately, may or may not give the same amount of cash to the company that it expects these to have once the final product were assembled. And therefore, we look at can we really do an asset test of this firm? If we remove the inventories, how much is the firm able to pay its current obligations? Now again, notice that inventories are quickly converted to final products, typically within a business cycle, and sold off. So as the word suggests, it is a test. It's not really a true representation of the company's liquidity obligations. But yes, it does give us a good picture of the obligations that the company can meet in the short term. The third is really an important and a very harsh kind of a test, which is essentially the cash that the company holds at any point of time divided by its current liabilities. So current assets may have items such as marketable securities or small investments or receivables, which typically are received within 60 to 90 days, but cash ratio is really harsh on the company, or a harsh test of company's liquidity obligations. So we will now analyze these in the context of our airlines. MKZ, which is a large airline, it has current assets of 8,249, long-term assets of 56,283, and total assets of 64,500. With respect to KMZ, which has current assets of 875, total long-term assets of 3,250, and long-term assets of 4,100. Now we'll only look at the formulae for MKZ, the larger airline, but we'll compare the ratios across the two airlines. So how we calculated the total balance sheet and income statement in our previous chapter. The new additions here are, in the case of MKZ, for example, the earnings per share. So we have this net income, we get the number of shares outstanding, and we get the ratio of those two as earnings per share. So net income divided by number of shares outstanding is earnings per share, or profit per share, or net income per share. And then we need to find out the growth rate of earnings. And how do we get that? Growth rate of earnings typically is, we look at earnings this period, earnings previous period, and the earnings prior period to that. And then we look at how it has grown on an average. So we will be using this formula in present value chapter, which is coming up. But for now, it's sufficient to know that we need to find out the growth rate of earnings. So with that in mind, let's look at the liquidity ratios of MKZ Airlines, a large one. So here we go. Current ratio is a ratio of current assets to current liabilities. Current assets are 8,200 and current liabilities are 20,200. The ratio is approximately 0.4. The quick ratio is current assets minus inventories, 8,200 minus 1,200 divided by short-term liabilities. So it is about 6,000 divided by 20,200, or approximately 0.35. And the quick ratio is simple, cash and its equivalents, B3, divided by short-term liabilities. So 2,880 divided by 20,200 is approximately 14.26%. So that's how we find out the current ratio for MKZ Airlines. Now, MKZ Airlines is a large airline. When we compare it with the smaller KMZ Airlines, we can look at it here. So MKZ had that current ratio of 0.4 versus KMZ 0.8. So KMZ, the smaller airline, is much more liquid. It's able to maintain its liquid assets much better. It could be perhaps because MKZ, the larger airline, is easily able to raise cash from its lenders when it needs it, and so therefore it keeps deploying its cash into assets to earn interest. So that is another aspect. So the trade-off between liquidity is the opportunity cost. The money that is available in a company's bank account could be potentially invested in short-term securities to earn some interest. And we're not talking about small amounts here. Some of these companies have millions of dollars in current assets and liabilities. So they invest it in the short run assets. So the quick ratio of KMZ, the smaller airline, is much larger than the quick ratio of MKZ Airlines. So 0.78 versus 0.35. The implications are current ratio typically more than 1 is very useful. Net working capital therefore becomes positive. And the current ratio very large as compared to 1, it's really a representation of cash not being employed correctly to earn returns on that cash. Now we talk about financial leverage ratios or the long-term solvency ratio. These are also very important. First ratio is debt ratio. It is total assets minus total equity, which is basically both a sum of short-term and long-term equity divided by total assets. Then there is times interest earned, which is an income statement item. How much is the earnings before interest and taxes as a ratio of the interest expense? So the larger the earnings before interest and taxes, the more is the ability of a company to service its interest expense. Then the next one is the cash coverage ratio, which is the earnings. So earnings before interest and taxes is not a true representation of cash flow for a company because the company has never paid depreciation expense during that period, right? So we add back the depreciation to get a operating cash flow for that company before taxes, of course, and divided by the interest expense. So this is the real cash ability of that company to service its interest expense. Now, typically firms earn large amounts of profits as compared to their interest expense, and therefore these ratios, times interest, cash coverage ratios, are expected to be bigger than 1, much bigger than 1 actually. So in terms of MKZ and KMZ, the smaller airlines, let's look at these. So we have the debt ratio of 0.76, which is the ratio of D12 minus D11 divided by B12. So D12 is the total assets minus D11 is owner's equity divided by total assets. So it's basically all the current and long-term liabilities divided by the size of its balance sheet. The next one is times interest earned, which is EBIT divided by interest expense, and like we said, it's way higher than 1. So the ability of a firm to service its debt obligation is very high, and less than 1 could basically imply a lot of trouble for the firm, right? If you cannot pay your interest, their bondholders and lenders will be knocking at your door asking for their money. Then there is the cash coverage ratio, G7 plus G6. So you have EBIT plus depreciation, which is a cash flow divided by the interest expense. Again, this is even more large as compared to the times interest earned. So all in all, we can see that the larger airline, MKZ, is in a good position to repay its debt obligations. We compare it with KMZ. So 0.76 for MKZ, 0.73 for KMZ. They're almost similar. Times interest earned for the larger MKZ airlines is 19.78 as compared to 11.9 for KMZ. So again, very large for the larger airline. And then the cash coverage ratio is also very large for the larger airline. So we're not just talking about the size here, we're also talking about the proportion. So the proportion of cash that is earned in operations by the larger MKZ airline as compared to its interest paid is also very high, and that is being reflected in that ratio of 27.6. Now next we move on to the asset management ratios, and there are several of these. So first of all is the inventory turnover, which is cost of goods sold divided by the inventory levels at any point of time. So one is a flow, cost of goods sold is a flow, and inventory level is a level. So at any time the flow will be much larger because it's a flow during a period than the levels held. And it can be different also. I mean, sometimes inventory levels could be higher than the flows also, but typically it's not observed. Then next we move on to days sales in inventory. So if the flow is higher than the levels, then the days sales in inventory would be less than 365. And then the receivables turnover has a similar implication, except now here, because inventory has a direct link with cost of goods sold, level of inventory in dollar value will become the cost of goods sold when inventory is sold off. We have sales being linked with receivables. So if we make $100 worth of sales, out of which $25 is a receivable at any given point of time, then we churn our receivables 4 times a year during that given period. So that's 365 divided by that 4. Receivables turnover will be every 90 days we get our receivables back. And that's what the days sales and receivables mean. And then finally, the total asset turnovers is sales divided by total assets. Now, this may or may not be more than total assets. Usually it is. Usually sales is a much higher number. But again, it depends on the nature of that industry. So sales divided by total assets is the total asset turnover. How many times does the assets, total assets of or the balance sheet of a firm gets churned over in terms of its sales? Now we look at it with respect to MKZ, the larger airline. The inventory turnover. So the inventory number comes from right here, the red cell here, 1251 for MKZ divided by cost of goods sold. So again, like we said, the flow number should be much more than the levels held at any given point of time. So it's 23,086 divided by 1251, which is approximately 18.45. So inventory turnover in a year, assuming that the income statement is an annual income statement, is 18.45 times. And so the days sales in inventory becomes 365 divided by the 18.45 or 19.77. So about 20 days inventory is churned over every time to make sales. Then the receivable sale turnover is sales divided by receivables. So sales is G2 and receivables is in B5. So sales is 47,000 and receivables is 2854, and the ratio of 2, again, flow versus levels, right? So it's going to be much more than 1, 16.47. And what does that mean? It just means that receivables are turned over 16.47 times a year. Now notice, if the income statement was semi-annual, that would be 16.47 times every 6 months. And so the days sales in receivables therefore becomes 365 divided by the receivables turnover. So the receivables are turned over every 22 days. Finally, the total asset turnover for the larger MKZ airline is 0.72. Now, again, this is a very relative number. So we have large amount of total assets, aviation industry being a capital intense industry. It is expected that the total assets for airlines is large. So the revenue that is churned over is only 47,000 per year, but the total assets are 64,500. So the ratio of those two is 0.7284. And that's the total asset turnover. It may or may not be less than 1 depending on the industry. Capital intensive industries are less than 1, but again, companies like software industry, or if a firm is opened in a startup fashion or in a garage, then the total asset turnover could be very, very large, particularly if they're making robust sales. So moving on to these comparisons now, the larger MKZ Airlines has a smaller inventory turnover as compared to the smaller KMZ Airlines, 18 versus 58. And then we have receivable turnover, which are almost the same, 16.47 for MKZ versus 17.48 for KMZ. And to conclude, we saw how financial ratios can help measure and analyze the performance of a company. In particularly areas such as efficiency, profitability, and we can compare with itself over time or with another company at the same time. Then liquidity financial ratios help determine the payment position of a company, particularly with respect to the short term. Solvency financial ratios look at more long-term debt obligations and how the company can usefully service these debt obligations. And asset management ratios are very useful in looking at the efficiency with which receivables or inventory, so both production and sales side, are looked at, as well as total assets. So how are these assets managed with respect to the periodic sales? And that is chapter 4, part 1. Thank you for listening.